Hey, what's going on everyone? It's Griffin here, and I hope you all had a great past couple of days. Now, with the new year approaching, I thought it would be a good idea to redo an audience favorite here on the channel that I released last February, which was the Easy Model Portfolio, which amassed over 40,000 views since then. But since last February, a lot has changed in the stock market. Certain industries have performed quite differently as a result of the pandemic, and equities have seen extremely large price swings. So now, almost a year later, I've had quite a few viewers requesting that I make an update video on the Easy Portfolio, but this time with $10,000 rather than say $3,000 or $5,000. And I thought this was a great idea since $10,000 is a quite reasonable starting point for an investment portfolio, or is extremely achievable by anyone watching. These type of model portfolio videos seem to do pretty well on the channel and are well received by the audience since, it can be somewhat confusing to start off with an initial amount of capital and then craft a portfolio that suits your needs as an investor with proper asset allocation for long-term growth of the value of your portfolio. So it goes without saying that these are really just that. They are model portfolios, and in no means do you need to actually mimic these down to the exact position. But the reality is that if you're just starting out with say $5,000 to $10,000 to start investing with, you're much better off actually building out a foundation to your portfolio that's going to have less volatility than going ahead right away and trying to pick and choose individual positions that are going to beat the market. This is going to allow you to have a more steady appreciation of the value of your portfolio over time while you learn to better navigate the market and analyze stocks correctly. So that's exactly what we're going to be speaking about in today's video. Let's first start off with some expectations as to what a $10,000 portfolio can look like in terms of capital appreciation as well as dividend income in a given year. Even though we can never 100% pinpoint a market returns for a given year, case in point, this is one of the most volatile years in history. And also make sure to stick around until the end of the video because I'm going to be announcing the winner of the Wealthsimple backpack. Alright, so first and foremost, dividend stocks that should be of interest to us to invest in the first place are what's known as dividend growth stocks. These are companies that have a consistent track record of distributing as well as raising their dividend distributions each and every year, such as for example the 4 dividend stocks that we spoke about in my recent dividend stock video. This is important to us as investors because it ensures that the dividend distributions will continue increasing over time and at a minimum keep up with inflation while also being able to compound at a quicker rate. It's also important to keep in mind that with dividend stocks or with exchange traded funds, which this video is focused on, we're really not going to be looking here at 50 to 100% gains, which I know a lot of newer investors have come to expect, but that's not really the reality with average market returns or a portfolio that's well diversified with proper asset allocation. But a more conservative and level-minded approach to investing for the long term anyways is going to be building out a more solid portfolio with exchange traded funds and dividend stocks that have that consistent track record instead of dumping all your funds into extremely high risk stocks. With that said, I am including some positions in today's model portfolio that do have a higher potential for appreciation over the long term that I think will benefit any portfolio for the foreseeable future. Okay, so generally speaking, dividend growth stocks are going to pay out a dividend yield that fluctuates between 2.5 to around 6% on the higher end. This is typically the sweet spot for dividend yields, even though this can vary from company to company based on a variety of factors, but this is a pretty standard range. So with this in mind, if you were to deploy that $10,000 into this type of income yielding position, you'd be looking at dividend income on an annual basis from anywhere around $250 to around $600, and that's some pretty simple math based on invested capital and a dividend yield ranging between that 2.5 to 6%. But in the case of this model portfolio, I'm not recommending putting that entire $10,000 into dividend stocks. Rather, I would be looking at more of a smaller position in dividend income stocks or ETFs, and we're going to be looking at all of this in entirety later on in the video. Alright, so let's now loop back around to the asset allocation and crafting of that $10,000 investment portfolio, which once again is obviously going to be different and vary for each individual based on a variety of different criteria for your own situation, based on, for example, your age, your time horizon, risk tolerance, income, etc., as well as if this is a new portfolio in its entirety or you're just adding $10,000 to an existing portfolio. right? So someone like me who's say 24 years old is gonna have a portfolio that looks quite a bit different than someone that's say double my age. But for today's video, we're gonna be focusing on a portfolio that I would recommend for someone who's between say 20 to 30 years old, that has a longer investment horizon ahead of them, as well as being more risk tolerant and being significantly more bullish on equities. But if you are an older individual, nothing says that you can't take this information and tailor it to your own needs as an investor. Typically, this is going to include a higher amount of fixed income position, lower volatility in the portfolio, and just a more conservative approach overall. So yeah, an individual that is in this 20 to 30 year old age bracket and that has a significantly longer investment horizon ahead of them can afford to allocate a higher percentage of their portfolio to individual stocks, equity ETFs, as well as real estate investment trusts. Even though quite a bit has changed in the stock market since last year, my overall views on portfolio construction haven't changed all that much, in that I would still allocate a very high percentage to equity positions for an individual in that age bracket. So at a minimum, 80% of overall portfolio value in equity positions, even reaching up to 90%, which in my case is how my portfolio has since evolved. And then from there, 20 to 10% in fixed income positions. Typically, I recommend fixed income exchange traded funds. Now, this comes down to the concept of proper capital allocation within an investment portfolio, where you're going to want to allocate a certain amount of your funds to equity positions and then also a certain amount of funds to fixed income positions in relation to your overall strategy and needs as an investor, because this is going to allow your portfolio to have somewhat smoothed out returns and more steady returns in different market cycles. This is also historically applied to bond yields that typically go up when interest rates go down. But in all honesty, while I do still believe that it's of importance to hold a certain portion of your portfolio in fixed income vehicles, well, in this market environment, bonds in my view aren't necessarily as attractive as they used to be, and their performance has been somewhat subpar. In addition to this, savings yields are extremely low right now in high interest savings accounts as a result of slashed down national interest rates, which pretty much are at all-time lows right now. But all of this to say that it's extremely difficult to produce a fixed income in a portfolio right now. That's to say, other than if you were to replace a portion of your fixed income position, which would have been in bonds or bond ETFs, with now some very low risk and conservative dividend stocks that have a higher dividend yield and that have that consistent track record of paying them out over time and then also increasing them year over year for a given amount of years. For example, in my own portfolios, I tend to just go for a bond ETF rather than individually selecting bonds, because it just makes life a lot simpler. Two of my go-to bond funds are VAB and VGV by Vanguard Investments, but as we can see here, year to date, VAB is only up, 5.09%, and their yield is 2.63%, while on the flip side, VGV is up 5.15% year to date and has a yield of 2.37%. This isn't to say that bond ETFs or other fixed income positions don't still have a place in a modern portfolio. I definitely think that they do. All I'm saying is that in current market environments and with lower bond yields, I think that for a younger individual who does have that longer investment horizon ahead of them, that can compound their gains, continue contributing to the account, and so forth, I think there's more value in allocating a much larger percentage of the portfolio to equity positions over fixed income. And for this reason, when I am looking to generate some cash flow or some income in my dividend portfolio, well, lately I've been leaning more towards dividend aristocrats to generate that healthy income in the portfolio. Okay, so back to the $10,000 portfolio. If you were to allocate, let's say 10% of the portfolio to a fixed income fund like I would recommend, this would represent around $1,000 worth of securities purchased. I would still recommend either VAB or VGV for ease and simplicity, both of which are still going to offer your portfolio some hedging against equity market corrections. Either of these funds is still going to expose your portfolio to a basket of shorter and longer term bond positions at a low management fee. Now that we've spoken about the fixed income positions for this asset allocation, let's speak about the equity portion of the portfolio, which in this case is mostly going to be comprised of exchange traded funds for various different goals. This isn't the first time that I've mentioned this concept on my channel, but in my view, if this is a portfolio that's somewhat new and has a balance below, say, $20,000, $25,000, and you are looking to invest for the long term, which you should be, then it's really important that you first build out that foundation to your portfolio with what I call core ETF positions. And these are going to be exchange traded funds that you hold in your portfolio and continue contributing to, that are going to allow the portfolio to benefit from steady increases in capital gains over the course of your investment career. These core positions don't necessarily have to have anything all that special about them or have, let's say, a very high dividend yield. These are really going to be positions that act as a guiding baseline for steady portfolio appreciation over time. And then from there, once you have built out this strong foundation, you can then go ahead and pick individual positions around your core holdings. These core ETFs include, for example, VFV or XUS, which both track the S&P 500 index, and I recommend typically to a new investor, around 25% of the portfolio could go to an S&P 500 ETF like this one, and then from there an ETF like HXQ or XQQ for the NASDAQ 100. XQQ is going to be hedged to the Canadian dollar if that's what you're looking for, and for a NASDAQ 100 ETF, I like to allocate typically around 20% of the portfolio. This for new investors is what I think is appropriate. Straight off the bat, just these two positions combined to create a really solid base for the portfolio, which you can then build off of. Continuing on with the exchange traded funds for this portfolio, with everything that's going on in the world right now, globalization and these emerging markets that are showing extremely nice gains over time, I would also recommend an emerging markets ETF, like for example, XEC by iShares. This type of ETF is going to offer your portfolio exposure and diversification to equities from emerging markets. Some of them are going to include China, some are not going to include China. I would typically recommend having an exchange traded fund that is going to include equities from the Chinese market. Emerging markets like these are really starting to show an increased promise for international impact, and for a starter portfolio, a smaller position anywhere from say 5 to 10% can be beneficial in my opinion. Moving on to two other ETF positions that are going to be more dividend focused, we have XRE, which has a dividend yield of roughly 3.87%, and this is the S&P TSX Capped REIT Index ETF. It's going to expose you to the largest retail investment trust in Canada, which some have seen a rough ride in 2020, but others are thriving, like medical, industrial, or apartment REITs, and then most of these retail REITs are looking to really pivot towards other facets of real estate to avoid becoming obsolete. XRE is a nice option for dividend income. Other dividend-focused ETFs would include, for example, XDV, also by iShares, which is the Canadian Select Dividend Index ETF that focuses mainly on the financial, telecommunication, and energy sectors in Canada. This ETF currently has a distribution yield of around 4.20%, and the management expense ratio is 0.55. Now, if you do want to pick some individual dividend stocks for your portfolio, then that's totally fine. I've already made quite a few videos on the channel speaking about dividend stocks individually, like this one right here. I definitely recommend that you check that one out if you haven't already, moving into 2021. With that said, if you are going to individually select certain dividend stocks or other types of equity positions, I would keep these to below 30% of the overall portfolio allocation, because I believe that there's significantly more value in the diversification and passivity that these core ETFs are going to provide when you're first starting out with a portfolio of around $10,000 than that couple $100 extra in dividend income annually. And finally, for this model portfolio, I've also included actively managed exchange traded funds, which typically I avoid due to high management fees, but these are actively managed funds by ARK Invest, which you may be familiar with, as I have made a full video going over their value propositions and the stocks that are held within these funds. The reason why I like these ETFs is because they expose you to extremely innovative companies that the fund managers at ARK Invest are picking out and purchasing at opportune moments in the technological adoption curve. We won't go into full detail about all the characteristics of these funds in today's video. If you want to learn more about them, then make sure to check out my full ARK Invest fund video. Another thing I really like about ARK Invest actively managed funds is that for the level of service and returns that you're receiving for these funds due to the actual companies held within them, a 0.75% management expense ratio is on the higher end for passively managed funds, but for active funds, like for example a mutual fund, this is actually quite low, as mutual funds will often go up to a 2.5% management fee. So two of my favorite funds by ARK Invest are ARK-K, which is their largest and most well-known fund, and then I also like ARK-G, which is the ARK Genomics Revolution ETF. These two funds are really great, and I think holding them long-term in a portfolio is going to be extremely beneficial. For this reason, I would recommend up to even 20% of a newer portfolio be comprised of these ARK ETFs. You could, for example, divide it 10% into ARK-K and the other 10% in ARK-G. All right, so that pretty well wraps up today's video going over the new model portfolio for a $10,000 initial investment portfolio. I really hope that you enjoyed this asset allocation for someone who's in the 20 to 30-year-old range. Now, obviously, tailor this to your own realities in terms of fixed income versus equity positions, and then drill down in the equity positions for an asset allocation within that equity portion for each individual ETF or stock that you're including. I really hope you enjoyed the content of today's video, but we're not done yet, because in the last video, I announced that I would be giving away the Wealthsimple branded backpack that we spoke about in that video, and there was an unreal amount of engagement in that video. Honestly, I was pretty surprised. Basically, I just asked everyone who wanted to participate to comment down below their goal or one of their goals for 2021, and they would be entered into the giveaway. So I'm going to be doing a completely randomized giveaway for this backpack that I'm going to be doing on a randomizer on the internet. So that's it for today's video. I really hope you enjoyed it. If you did, give it a thumbs up. It really helps the channel out. And also make sure to comment down below what are some other content ideas that you'd like to see on the channel moving forward, and subscribe to the channel and hit the bell button so that you're notified whenever I release new and upcoming investing content. I really hope you have a great new year, everyone, and I'll see you in the next one.